When most people hear the word annuity, their immediate reaction is skepticism. The concept often carries the weight of a heavy vault, an outdated, restrictive contract that traps your money behind layers of penalties. This skepticism is usually tied to a very specific demographic myth. There is a persistent belief that these tools are strictly reserved for the ultra-rich looking to dodge taxes, or for individuals well into their 80s. But standard retirement tools carry their own massive vulnerabilities. Your 401k remains fully exposed to sudden market crashes right when you need the money most, and traditional savings accounts consistently fail to generate enough yield to outpace inflation. This T-chart separates cultural noise from actual utility. Annuities are a spectrum of distinct financial tools designed to secure income, defer taxes, or protect your principal. The assumption that annuities always guarantee terrible returns is often based on products from decades ago. These low-return myths misrepresent how modern, index-linked structures operate today. Modern products are engineered precisely to solve specific financial frictions that occur at different stages of your life. Finding the right fit for a retirement plan is an exercise in precision. It requires matching a specific contract to your actual financial fear or goal. Failing to understand this distinction is a costly mistake. It causes millions of retirees to walk away from the exact financial safety net they are actively trying to build. To evaluate if one of these tools fits your portfolio, we have to look at the mechanics. An annuity is a calculated, legal exchange of resources between you and an insurance company. The terms of this trade are straightforward. To get the benefit, you must surrender immediate, short-term access to a portion of your capital. You are locking that money up for a set period of years. This quadrant chart plots exactly what you get in return for that sacrifice. By accepting a high liquidity cost on the x-axis, you secure a legally guaranteed outcome, like absolute protection from market loss, or an income stream that lasts until you die. You are trading away the potential for speculative stock market gains. That is the necessary mathematical cost for establishing an absolute financial floor that cannot collapse. If your cash position is fragile, locking up your liquidity is dangerous. But if your financial foundation is already strong, trading a portion of your liquidity for absolute certainty is a highly optimal strategy to preserve your wealth. Let's apply this trade to the pre-retiree. In your 50s or 60s, you are navigating the pivot from accumulating wealth to preserving it. The primary friction here is psychological and structural. You are preparing to step away from a predictable, bi-weekly paycheck and rely entirely on a fluctuating pool of accumulated wealth. This decision tree maps out how we solve that exact friction. If your concern is approaching retirement, the objective is securing future income without heavy market risk. This path leads to a fixed-indexed annuity, or FIA, which legally protects your principal from downturns. The mechanics rely on a guaranteed lifetime withdrawal benefit, or GLWB. This rider guarantees a set withdrawal percentage for life, even if your balance drops to zero. By locking this in during your 50s, you secure a mathematically predictable paycheck for the day you retire. The trade-off for this setup is capped upside. During your final working decade, the money inside this contract will not capture the highest possible speculative peaks of a roaring bull market. For the pre-retiree, giving up peak speculative gains is a mathematically sound price to pay. It removes the risk of a market crash destroying your baseline lifestyle right as you leave the workforce. Consider a high-income earner who has maxed out their 401k plan, their IRA account, and their health savings account. On our decision tree, this highlights the capped out on taxes branch. Surplus income in standard accounts faces heavy annual tax drags. The targeted solution is a non-qualified deferred annuity. Funded with after-tax money, it completely bypasses the strict IRS contribution limits capping traditional accounts. With no contribution limits, high earners can park massive amounts of surplus capital into these contracts, letting it compound with total tax deferral. The trade-off is strictly temporal. The IRS will hit you with a 10% penalty if you withdraw those earnings before age 59 and a half. This makes it a highly effective vehicle for long-term wealth accumulation, but entirely useless for mid-term liquidity. Our third persona involves navigating sudden wealth. This applies to individuals holding a massive lump sum of cash. typically from an inheritance or business sale. We follow the holding a sudden lump sum branch. Placing newly acquired wealth into volatile equity markets carries severe psychological danger. The precise instrument to lock down this capital is a multi-year guaranteed annuity, or MYGA. It guarantees a specific fixed interest rate for a predetermined number of years. By utilizing a MYGA, the entire principal is shielded from market losses, generating a highly predictable, tax-efficient yield over the exact term you select. The strict surrender charges built into a MYGA are actually a behavioral feature. They make it difficult to access the funds, preventing disastrous impulsive purchases with the windfall. There is one final, highly specific demographic that utilizes these contracts: the early retiree planning to exit the workforce before the age of 59 and a half. On our final branch, the hurdle is clear. Early retirees need consistent cash flow, but tapping retirement accounts early triggers a 10% IRS penalty. The solution is a single premium immediate annuity, or SPI. Handing over a lump sum guarantees an immediate income stream, completely exempt from early withdrawal penalties. The SPI reclassifies existing assets to generate early cash flow without government penalties. We have covered who benefits from these contracts. Now we need to define exactly who must avoid them. If your life situation is highly fluid, if you lack a fully funded emergency savings account, or if your primary investment goal is chasing speculative, crypto-style market gains, annuities are the wrong tool for you. This checklist matrix spells out the mathematical danger. Buying an annuity when you might need to access that capital within the next 1 to 3 years will result in a financial disaster. If a sudden medical bill or a broken boiler forces you to break the contract early, the insurance company will apply severe surrender charges. These penalties will deplete the wealth you were trying to protect. If you fall into this short-term liquidity category, bypass the annuity market. You need tools designed for immediate access, like a high-yield savings account or a standard certificate of deposit. An annuity serves as a final layer of certainty when your financial foundation is already stable and your goal has deliberately shifted from speculation to absolute safety. Because the actual mechanics vary based on your exact age, your tax bracket, and your required cash flow, guessing which product fits your situation is a catastrophic error. Professional mathematical analysis is required. Use the contact information on the screen to set up a free, objective consultation. Get the math checked and determine if trading your liquidity for certainty actually solves your specific financial dilemma.